Okay, let's start. Welcome to Love for Accounting. It has been a week since I last live. Today we will work on this paper, September year 2020. This is our fifth set of paper. So let's look at the paper. Okay, again, 100 mark for the paper, 5 questions, all compulsory. Question 1. Okay, we have 6 items of information, and then we have to calculate trade receivables, allowance for doubtful debt adjustment. Okay, again, be careful. We have to look at whether we need the balance or the adjustment. Okay, this time it is the adjustment. And then extended trial balance. 2 more short questions. Okay, always for all the 5 sets of paper, okay, all extended trial balance in the first one, and then last one statement of cash flows. Let me set the question information first. Extended trial balance. Okay, done. So Lola provided the following information in addition to the extended trial balance extracted on page 3 of the question paper. Discount received had not yet been posted from the cash book. Okay, so it means that it is in the cash book but then not posted. Yes, okay, but then that will affect both our trade payables. Discount received is from suppliers, okay, and also the discount received account. Yes, so let us update. Discount received 85 not yet posted, so discount received is a credit side account. So if we want to add 85 here, trade payables credit side account, because we will reduce the amount, reduce the balance because of the discount received. That's why we debit. Okay, item 2, rental income 2160 had been posted to the irrecoverable debt recovered account. Wow, so strange. Rental income 2160. So this would be an error of commission 2160. We have to deduct it from the irrecoverable debt account 2160. This is an income account, and also for the rental income, also credit side account. Okay, if we want to reduce the amount of irrecoverable debt recovered, then debit, and then add back to the rental income account. Question 2 finish. Okay, still no effect on trade receivable, which we have to adjust for item A. Disposal proceeds 5,000 had been posted to the sales revenue account and bank account. We know that for disposal proceeds, it's not sales. We receive money from the sale of non-current asset, but then it is not sale of goods. Okay, so 5,000. Bank is correct, but sales account is not. Okay, so sales account is a credit side account. So if we want to reduce 5,000, we debit. Okay, let us see. Yes, we have disposal account. Okay, disposal, we don't have any designated debit or credit side nature, okay, because it can be a disposal income, it can be a disposal loss. So 5,000 here. Next, Lola introduced her personal computer 895 into the business. This had been debited to both the computer's account, which is correct, okay, and the drawings account. Okay, debited, both debited. Okay, so if a partner or a owner introduce her personal belongings into the business, that would be an injection of capital, injection of equity. So it should be added to equity, 895. Okay, but then it had been debited to drawing. So we do this one more time because drawings is a debit side account. Okay, and because of this, 895 multiplied by 2, we have 1790 debit to the suspense account. Okay, 4 items down. No entries have been made in accounts for the check receipt of 625 from a credit customer owing 2500. The balance is to be written off as irrecoverable. Okay, no entries made here. So 625 2500. Let me mark down first. It is an irrecoverable debt, but then we have to find the balance. Let me use green for this one. So trade receivables is a debit side account. Okay, it pays us something, but then we will write off the remaining. So in any way, the trade receivable will be reduced by 2,500. This 2,500 is settled partly by a receipt, 625, and then the remaining to be written off as irrecoverable debt, 1875. Okay, debit side. This one is also debit side. Okay, here we can see that the trade receivables, okay, first thing, reduced by 2,500. Let's see if we have any other things. Okay, next is an allowance, 5%. Okay, so that means it is the only adjustment we have to make, 37500, the original. And then let me look at the allowance for doubtful debt, 2250, opening balance. Okay, so let us finish this one. So originally it is 37500. Okay, and we have to reduce by the amount of payment and irrecoverable debt. That gives you a balance of 35000. Okay, allowance for doubtful debts adjustment. Okay, originally it is 2250. Okay, so this is the old balance. We have to calculate the new balance being 35,000 and then 5%, 1750, and then the adjustment being 500 negative. Okay, we have to reduce. Okay, reduce by 500. Okay, and having this piece of information, we can continue with the extended trial balance. Allowance for doubtful debt, it is a credit side account, and if we want to reduce, then debit. Okay, and also here, the adjustment 500. Okay, here we have one more line. Okay, that is of no use. Okay, but then here I will calculate the total. okay, to make sure I use the double entry system when working on the adjustments. Yes. Okay, it is not required though. Okay, and in the other key, it is also not there. It just, you know, give you an extra line for nothing. Okay, but then that's fine. Okay, state one type of error that would be reviewed by a trial balance and would not be reviewed by a trial balance. Okay, this is quite simple. Okay, for example, here we have error of commission, okay, principal, okay, or complete omission, complete reversal, okay, original entry. I can name so much. Okay, that, okay, sorry, I am so sorry. This would go into the next one. Okay, why am I making such mistakes? Okay, so this, okay, be careful. Okay, this goes to the second one, would not be reviewed because these errors, okay, they fulfill the double entry system. Okay, so which would be reviewed by our trial balance? Okay, maybe we can have omission in part, okay, reversal in part, okay, something like this. Okay, 18 marks. Next question. Okay, we have some balances, opening and closing other receivables for commission, returns in revenue, and then commission received account, okay, where to put, and then the accounting concept related inventory account, okay, and then some concept questions. Okay, very strange. Okay, how should I classify this question? Let me say that, okay, it is, first of all, other receivables, oops, what happened to me, payables, okay, and also some sundry items. I can't classify. Okay, it's, you know, asking too many different things. Okay, anyway, John earns a commission of 10% on net sales. Okay, 10% on net sales. That's why you are given the sales and also returns in. Okay. Okay, and then opening balance of other receivable. Other receivables is in the debit side, is an asset. Commission received, okay, that is a commission income in arrears. Okay, they should have paid you but then haven't yet. Okay, so here, commission received account. Okay, so commission received is an income, so it is a credit side account. Okay, but then you are given on the 1st of April, year 2019, you have 2,800 as opening balance debit side. Year 2019, 1st of April, balance brought down. Okay, if you have to, give some explanation of it, okay, it is income in arrears. Okay, they should have paid you but then they haven't yet. Okay, that's why it goes to the debit side receivable. Okay, so before we work on the figures, okay, I would fill in all the items that we need first. Okay, when we receive money, year 2020, the end of the year, is it 1 year? Yes. No? Yes. Okay, 31st of March. okay, we should have received a certain amount. Okay, and then we have on the same day, okay, we have to see how much we will transfer to the statement of profit or loss. Okay, here I give some space for calculations. Okay, and then we would have a closing balance. Okay, because in the first page of the question, it asks you to calculate the balance, okay, to be calculated. So here, not much space, or I shouldn't skip lines. Okay, so if it continues to be an other receivables, it will be here. Okay, hopefully we won't get anything strange. Okay, income in arrears. Okay, so it will be from here. 31st March balance carry down. Okay, so we are given the amount of cash received from commission directly, 22500. Okay, 22500. So let us put it there first. 22500 amount received from commission. Okay, and then how much should be transferred? How much is the commission income? We can calculate it directly here. 10% on net sales. 225 and then 15. So here, 22500 is it? 225 15,000. 255 or 225? 255, yes. 255 and then 10%. 255, 15, and then we have 10%. It would be 24,000. 24,000 here. So 24,000. Okay, that means you will have a balance of 4,300 here. Okay, finished. 5 marks. Okay, one for date and description, I think. A2, state where in the following financial statements, okay, commission received would be shown. Okay, so in the statement of profit or loss, okay, it would be, of course, shown in the other income section. Okay, and statement of financial position, okay, it would be under the part of current asset. Okay, other receivables, right? State which accounting concept has been applied when adjusting for commission received. Oh, of course, accruals concept. Or interchangeably, you can also use matching principle. Okay, so 8 marks here. Let's continue. Inventory. On the 1st of April, inventory was valued at this amount, and then at the end of the year, this one. Prepare the inventory account. Okay, usually we just work on inventory in the statement of profit and loss. Okay, we have adjustment. Okay, but seldom do we need to show the inventory account. So if you do not know the stuff, okay, it's time for you to learn. Inventory account, it is an asset account, so it is in the debit side. Okay, so year 2019, you have 1st of April opening balance, right? So balance brought down here, 10500. Okay, so what's next? Okay, we know in the inventory account, by the end of the year, it will be changed to 16,500. But how? Okay, and remember, in the income statement, in the statement of profit and loss trading part, okay, cost of sales, okay, under cost of sales, okay, we'll have opening inventory, okay, add purchases and other stuff, and then less closing inventory. So that means both items will go into the statement of profit or loss. So how to show it? Okay, both items will appear. That means there will be a transfer, okay, of both items in the inventory account. So the first one would be year 2020. We transfer, okay, we take away the opening balance 10500, okay, 31st of March. We take it away. Okay, and then the second thing, let me change to another color. Okay, that will be on the same day, year end, 31st March. We have, I have to write the thing first. Okay, statement of profit or loss. Okay, and here, closing balance 16500. Okay, again, statement of profit or loss. Okay, because you can see this one goes here, and then the other one goes here. Okay, after that we will have the balance. Okay, because the opening balance is already taken away, so the only balance we have is 16500. Balance carry down. Okay, the last day of the year. Okay, equal sign 16500 here. Balance brought down. Okay, so you can see it becomes our inventory in the next year. Debit side, current assets. Okay, and the two transfer to the statement of profit and loss account is done. B2, state which international accounting standard applies when valuing inventory. Okay, so this is our old friend already, IAS2. State an accounting concept that applies when valuing inventory. So, for inventory, there are two main concepts that apply. One would be the historic cost concept. Okay, two, prudence concept. Okay, these two are the most important concepts related to the valuation of inventory. You can write either one. So next one, explain how an increase in closing inventory would affect the profitability and liquidity of a business. Okay, so two aspects, okay, 2 marks each. Okay, let us see. Increase in closing inventory. Okay, how would it affect profitability? Okay, so first of all, when we increase inventory, okay, when we increase closing inventory, okay, think back about cost of sales. Okay, opening inventory, add purchases, less closing inventory is equal to cost of sales. Okay, if closing inventory is increased, okay, that means our cost of sales would decrease. Okay, and profit and also profitability would go up. Okay, so profitability would be improved. Okay, and you just write the logic that we follow from the notes that I have written. Okay, because when you increase closing inventory, your cost of sales would decrease, Okay, that means your profit, both gross profit and net profit, would go up. Okay, that's why if other things remain unchanged, your profitability would be improved. Okay, and how about liquidity? Liquidity. For me, this one is you can have different answers for liquidity. Okay, because if you think of liquidity, the most important measure would be your current ratio and also acid test ratio. Okay, if there is an increase in closing inventory, okay, then current asset, current liability, then your current asset would go up. Okay, and your current ratio would improve. Okay, because you have more asset. Okay, asset test ratio, current asset minus inventory. You don't even count inventory in your asset test ratio. Okay, that means you won't have any effect if there is an increase in inventory, closing inventory. Okay, but then this is only the first impact of an increased closing inventory. Okay, if you think more, if you think again, okay, why is inventory increasing? Because you have kept more inventory. Okay, you fail to turn it into cash. You invest more money, more cash into inventory. Okay, that means if you think one more layer, okay, another effect, okay, you will have inventory going up, but then cash will be going down. Okay, that means your current asset there will be no change if you are looking at the current ratio. Okay, but then if you look at the asset test ratio, current asset no change. Okay, but then you have, we just look at trade receivables, other receivables, and cash. Okay, even if you have an increased inventory, it is not counted in the asset test ratio, and your cash decrease. Okay, you have less cash, you have worsened cash flow. Okay, and that would affect your liquidity. Okay, so it depends on whether you just look at the first effect, or you also look at the reason behind an increased inventory. Okay, here I would prefer to say that it deteriorate. Okay, liquidity will deteriorate. Okay, because more inventory, it means that it is holding up your cash. Okay, and that is also how we usually think of an increased inventory. Okay, so that's all for this question, 19 marks. Okay, that means we have more marks later in the later questions. Okay, third one would be partnership. Okay, let us see. Partnership. Okay, so partnership, let's see how this question goes. Okay, we have two partners share profit and losses equally. Okay, and then opening balance being on the 1st of August. Okay, after August we have something on the 1st of November. That is how many months afterwards? August, September, October, so 3 months afterwards. Okay, this is very important. Someone joined the partnership introducing 150,000 by check. Okay, the new partnership agreement provided that the profit and losses continue to be shared equally, but this time among 3 partners. Interest on capital 8% on balances after the partnership change on the 1st of November. That is opening balance for the new partnership, okay, changed partnership, and a salary for I don't know how, okay, for this partner T of 27,000 per annum. But remember, we only have 9 months after the change of partnership. Non-current asset revalued upwards, goodwill valued at 45, and partners decide not to maintain goodwill in the partnership books. On 1st of November, partner T provided a 10% loan, 40,000 to the partnership. The loan and the interest are repayable in 2 equal installments on 31st October and 31st October year 2021. Okay, so that is our next year end would be what, August? Before August it is July. Okay, so 31st July year 2020, this is our next year end. Okay, so that means this one is current. Okay, for the year ended 31st July, each partner took drawings of 26,000. Okay, including the new partner, I guess. Okay, and it didn't say per year, so it is a fixed amount, 26,000 of drawings. Okay, so what we need to do is partner T capital account for the year, I guess. It's not good. Okay, it should mention from when to when anyway. Okay, so for this year, and then complete the appropriation account. Okay, and remember this is 3 months, and then this is another 9 months. Profit for the year, okay, given to you how it is spread as well. Okay, and then calculate the current account balance of partner M. Prepare an extract of the statement of financial position, non-current liabilities and current liabilities. Okay. Okay, let's see. So, capital account of partner T. So what happened to him? Let us think of it first. Okay, have the concept before we work on the actual ledger account. Okay, so partner T opening balance capital being 150,000. Okay, and then we have the revaluation of non-current asset, and then goodwill revaluation, and then goodwill written off. Okay, nothing else. Okay, should be good. Okay, so let's start. capital account is in the credit side, equity. So year 2019, the 1st of August is our year start. Balance brought down 150,000. Okay, and we will work on the revaluation of non-current asset and goodwill first. So 1st of November, after 3 months, okay, we have the revaluation. Okay, and also on the same date, okay, we create the goodwill. Okay, revaluation 75,000 revalued upwards. Okay, the original partnership provided that they split the profit in half, okay, equally. So 37500, that is 75,000 divided by 2. And also for goodwill, 45,000 divided by 2. 45,000 divided by 2, that is 22500. And then after the partnership joined, we have to write off the goodwill. So 1st of November, goodwill written off. Okay, this time the same amount, but then we have 3 partners sharing the write-off of the goodwill. Okay, so that's it. Okay, so we have 195,000 after the change. Okay, nice. Okay, he did nothing, and then he have more capital. 31st July, and then we have balance carry down. Oops. I wonder if I do not write these totals, will I be deducted any marks? But I'm really, tired of writing these things. Okay, not much meaning, but then it takes me a lot of time and fun of working on questions. Okay, so 1st of August, okay, balance brought down. So next one, the appropriation account. Okay, so again, I will write all the things before I work on the actual calculation. So appropriations here, not many things to appropriate. Okay, first we have the salary, okay, of I think only T. Okay, and then we have the interest. Interest on capital. Interest on capital, we have all 3. So M, let me write T, and the new partners, what's the name? Okay, it is there. Oh, B here, SOHYA. How to pronounce these things? I really don't know. Okay, so we will have the residual profit or profit available for distribution. Okay. Okay, and then we will have the share of profit, and hopefully it is not loss. Okay, and of the 3 partners. Okay. Yes. So salary, let us go back. Salary for partner T, 27,000 per annum. Okay, remember to scale it down to 9 months. Okay, that would be 20250. 20250 negative. Okay, so nothing for the old partnership. Okay, interest on capital would be how much? What percentage? 8%. Okay, you can see that for partner M it is 150,000 as well. That means he will have the same closing balance like partner T. Okay, so the amount would be 195 divided, multiplied by 8%. Okay, and 9 months. Okay, it would be 20800. Is it? Let me calculate one more time. 19500. 8%. Oh no, it is 11700. 11700 for both partners. Okay, again, nothing for the old partnership. Okay, and also here. Okay, here, let us work on it. Okay, the original investment in check, bringing in a check. Okay, but then we have to have the goodwill adjustment. So 135,000, and then multiply by 8%, and then 9 months. 135, 8%. Okay, it is 8100. Okay, so I write it there first. Okay, so we will have the residual profit 36,008 minus 56250. Let's check. Yes. Okay. So last one, share of profit for the first half of the year. I mean not half, but first 3 months. Okay, 18,000 shared equally. Okay, nothing for partner S. Okay, 56250 and divided by 3, 18750. Okay, it seems that the original partnership is, more profitable. 3 months? Not really, because we have the other appropriations there. Okay, so 36750. Okay, because this one will go into the current account of the partnership. Okay, finished. 7 marks, not much, but then it is not difficult. Okay, we just have to be careful because everything, except for the share of profit, we have to scale it from 1 year to 9 months. Okay, if you forget this part, okay, you will lose, almost all. Okay, 4 points out of the 7 marks. Okay, so next one, calculate for partner M. Okay, how much would be the balance of the current account? Okay, so again, concept first. Originally we have 4,500 debit. That means negative. Okay, be careful, negative 45,000, and then all the current account entries. Okay, we will have first of all all the appropriations item. For M, it would be, let me circle it first. Interest on capital. Okay, I will encircle the total one because here we will circle the total as well. Okay, 36,750. Okay, so appropriation items and also the drawings. Okay, so let us start. Let me mark down the number first. Okay. Okay, so 4500 negative. Okay, and then appropriations being 11700 interest on capital. Share of profit 36750. Don't forget, for each year we will have this one. Okay, this is the drawings. Okay, so 4,500, 11700, 36750, and then the drawings. Okay, is equal to 17950. Done. Yeah. Okay, 3 marks. Okay. Sometimes we will also need to work on the current account of this partner M. Okay, then we will have an opening debit balance. Okay, appropriations positive here, 36750. Okay, and then drawings here. Then we have the closing balance, positive closing balance. That means goes here, like this. Okay, but probably they won't have the marks, okay, to ask you to work on the current account, because for this current account at least they have to give you 1, 2, 3, 4 marks at least. Okay, maybe they cannot spare this 1 mark. So prepare an extract of the statement of financial position showing the non-current liabilities and current liabilities section. Okay, so we do not have any other information, just the loan. Okay, remember that partner, who, M or T. Let us take a look. Partner T. Okay, he provide a loan of 10% interest. Okay, 40,000, and then repayable by 2 installments. Okay, and for the current part, okay, I mean for the first installment, it will be in the current liability because it will be repaid within 1 year. Okay, so that means first of all, you will have 10% loan from him, okay, in both items from, okay, and that would give you 20,000. Okay, this I would do it like this. Okay, because you will have one more item of non-current, of current asset. Okay, you have, interest accrual here. Other payables. Okay, interest. Oops. interest. Okay, so the loan is made on the 1st of November. Okay, and this year, the first year, for 9 months, you have borrowed 40,000. Okay, 10%, and then for 9 months. Okay, this amount you have to pay together with the first installment of the loan. Okay, so 20,000. No, 40,000. 10%, 9 months. Okay, 3,000 interest. Okay, and here I also give the total. Okay, so this total you can choose whether to give it or not, because for this extract, usually, of course, during your operations of the company, you will have other current liabilities. Okay, trade payables, or other payables, you still have accruals for other items. Okay, so it's just an extract showing the things related to loan. Okay, so whether you give the total is not, it's not compulsory. Okay, but I'll just keep good formatting. Okay, so 2 marks only, yes, for this one. Next, we have to write about the profitability of the partnership. Okay, you gave me other ratios but not the profitability ratios, but then I have to evaluate. Evaluate the effect on profitability. Oh, then that's easy. Okay, just like our previous question. Okay, increase in inventory, how will it affect profitability and liquidity? Okay, now it focuses on profitability. Okay, so let us see. Trade receivables collection period is increased. Okay, that means usually, okay, that means trade receivables increase. Inventory turnover decreased. Okay, that means usually you have a decreased inventory. Okay, profitability, how will it be affected? Okay, so trade receivables. Okay, so again, we will look at 2 ways. Okay, whether profitability will be improved or it will be deteriorated. Okay, and then make a conclusion of it, 5 marks. Okay, so let me see. Trade receivables, when it is increased, okay, the first effect would be, okay, it is possible, okay, for irrecoverable debt. Okay, because when they are paying later, okay, you have a higher risk of irrecoverable debt, and this would affect your profitability if you have more expenses. But then if you think of it the other way, okay, it can be a deliberate act. Okay, that is, you give a longer credit period to attract customers. Okay, and when you do that, you have more customer and you have higher sales. Higher sales also meaning higher profit. Okay, it can be both. Okay, how about inventory turnover reduced? Okay, so inventory turnover reduced means that inventory level is also reduced. Okay, it can be a good thing. It can be a thing of concern. Okay, because we have to look at both, do evaluation. Okay, both sides will be better. Okay, when inventory level decrease, it is good because it lower the risk of impairment. Okay, you sell your goods faster. Okay, and you have lower risk that your inventory become unpopular. Okay, and you improve on liquidity. Okay, you can use the cash to continue to buy goods, okay, and then sell it. Also, if you have lower inventory level, you will have less inventory management costs. Okay, you do not need so large a warehouse. You do not need to hire so many securities and warehousing staff. Okay, this will help you reduce expenses. Okay, and improve profitability. Okay, but at the same time, if it goes to extreme, okay, inventory, let me see, inventory turnover times. Inventory, okay, no. Inventory turnover times decrease, it does not mean inventory decrease, it means inventory goes up. Okay, then that is another story. Okay, so if inventory go up, okay, I'm sorry, if inventory goes up, okay, that means, okay, we have already explained in the previous question. Okay, it means that, okay, you have, usually it is not so good. Okay, because higher risk of impairment. Okay, this is the first thing. Okay, and also just now I mentioned, okay, warehousing costs will increase as well. Okay, but the only thing that is good, okay, you can also say that, is to make sure you have enough inventory to be sold. Okay, so as not to lose sales. Okay, because sometimes if you have large order from your customer and you cannot provide, they will turn to other suppliers. Okay, and at this point it is important if we look at a reduced inventory level. Okay, so we have more points than you need. Okay, and then you make a conclusion of it. Okay, so that is question 2. Question 3, 22 marks. Next one, before, after we have a break, we will work on single entry. Okay, so you can see these this type of questions. Single entry can also be the sole trader. Okay, so some information. Okay, and then you have to calculate these things. Okay, and then statement of financial position, and then some identification questions. Okay, so I think it would not be too difficult. Okay, so let me write down first. Okay, question 4 would be single entry and also sole trader. Okay, financial statement of sole trader, I guess. Okay, if it is not, then we will change the information. Okay, so break time for me. See you soon. let us move on. Yes. Okay, so question for single entry and part of it sole trader. So again, let us take a look. We have to calculate for 31st March year 2020, that is closing balance, trade receivable, trade and other receivable, trade and other payables, okay, and then the adjusted profit, okay, and then the statement of financial position. Okay, so let's see what is given to us. On the 1st of April, Charlotte started business buying and selling goods on a cash and credit basis, introducing inventory 20,000, motor vehicle 30,000, cash 150, which is to be maintained as a float. Okay. Provided the following information: cash banked, okay, that is from cash sales, 6% loan, 50,000. Okay, so first of all, the opening equity, okay, the three investment added together, we have 50,150 opening equity. Okay, and for the bank summary, cash sales banked, 6% loan, which is usually, if it is not told, then it is non-current liability, 6% interest being 3,000 interest. Trade receivable is also from credit sales. Loan interest, okay, 20,000. Okay, we have to see if we have accruals. Okay, I guess so. Okay, so we have interest being 3,000, but then loan interest paid only 2,000. That means we have other payables of 1,000. Okay, accrued interest. Drawings 25,000. Equipment, purchase of equipment being 45,000, and then general expenses, purchases, trade payables, so cash purchases, and also payment to trade payables for credit purchases. The 6% loan is taken out on the 1st of July. Oh, okay, let's see. 6% loan. Oh, that means this is not the case. Okay, if it is only taken out on the 1st of July, okay, and year end being 30th, 31st March, that is half year, 9 months, 9 months only. Okay, so we have to see if it is for 9 months, then 3,000 multiplied by 9 months, 3,000, 9 months, okay, being interest being 2,250, and we have paid 2,000, that means 250 is accrued interest. Other payable, accrued interest. Okay, credit purchases given to us directly, credit sales given to us directly, closing inventory 340, 34000. Okay, depreciation on all non-current asset was charged at 20% per annum using reducing balance method. Full year depreciation charge in the year of acquisition, none in the year of disposal. So equipment 20%, 45,000, 20% being 9,000 depreciation for the year. Okay, the draft profit before receiving the following email is 39,900. Okay, so let's see the email. The email to a student from Charlotte. Hi. At 31st March, that is the closing date. Closing balance, trade receivables included 5,500 from a credit customer who cannot pay and is to be written off as irrecoverable. I would like to create an allowance for doubtful debt of 2,000, 2%. The bank is charging 6% interest per month on the bank overdraft. Okay. On the bank overdraft at 31st March, which needs to be paid by 30th April. Okay. So we do not know. Okay, we only have for 1 year. Okay, and it is charging 6% per month. Okay, so we have to assume that the overdraft, does it only appear in the last month of the year? Okay, I don't know, I guess so. Okay, if it is like this. Okay, so let us deal with trade and other receivables, trade and other payables. Okay, we have to look at the interest as well. Okay, so let us calculate the closing bank balance first. Here. Okay, closing bank balance. Okay, of course, being all the receipts added together minus all the payments. Okay, so let us calculate 158,000 minus 2,000, 25,000, 45,000, 62,750, 18,000, 105,000 being 13350. Okay, so if the closing balance being negative 13350, then bank interest for overdraft would be, okay, interest on bank overdraft would be 13350 times 6%. Okay, that is 801. Okay, and this is to be paid by the end of the first month of the second year. That means it is an accrued interest as well. Okay. We have two accrued interests. Okay, so trade and other receivables first. Okay, we have credit sales of 200,000. Okay, and trade receivables receipt is 158. Okay, and then 500. Okay, as irrecoverable debt. So that would be, let us write it there, 20,000, 158. Okay, here. Okay, so credit sales, and then 158 being the receipt. Okay, this is the closing balance before the bad debts written off, irrecoverable debts. So minus 500. Okay, so 200,000, 158,000 minus 500. Okay, that would be 41500. There is no other receivables, just trade receivables. Okay, because we are not given any information about that. Okay, trade and other payables, we use the same method. Credit purchases given to us 112,500, and then receipt from trade payables 105. Okay, so trade payables 112500, and then I forgot 105. Okay, 105. Okay, that is the balance for trade payables. And then for other payables, we have interest accrual on loan and also interest accrual on overdraft. Okay, so it would be 112500 minus 105. Trade payables being 7,500. Okay, and other payables 205, 801, 1051. Okay, and then that means we have 8551. Adjusted profit. Okay, we'll start from the unadjusted profit first, 39900. Okay, so 39900. Okay, and then two adjustments from the email. The first one is we have an irrecoverable debt, so it will reduce the amount of profit. And also we have 801, the interest on bank overdraft. So 39900 minus 500 minus 801. That is 801, yes. 39900 minus 500 minus 801. 39900 minus 500 minus 801. We have. Do we have any other thing? And also the 2% allowance for doubtful debt. If we have the 2% allowance for doubtful debt, then the trade receivables should also be reduced. Okay, so this one's not yet the answer. Okay, this multiply by 1 minus 2%. Is it? Let me check again. 2% allowance, yes. Okay, so 41500, 2% will be minus 830. Okay, 41500 minus 830. Okay, so this should be 40670. Okay, so we still have 830 here. So 399,500, 801, 830, 37769. Okay, that's it. I almost missed 1 point. Okay, why? Very careless. Okay, so after this, we can show the statement of financial position. The statement of financial position here. Okay, let me draw the lines first. Okay, so first part, it is the non-current asset. Okay, we have one non-current asset. So what is it? Oh, why? Okay, it doesn't allow me to draw the line in a good position. Okay, so let us go back to the payment equipment 45,000, and we have calculated that the depreciation is 9,000. Okay, and we also have motor vehicle 30,000. Okay, two classes of non-current asset 30,000. Okay, and okay, then it would be good for me to have the 3-column okay, so this is the cost, accumulated depreciation, carrying value. Okay, so we have equipment, we have motor vehicle 45,000, 30,000, okay, 9,000 depreciation, 6,000 depreciation, and then the total being 45 minus 9, 36,000, and then 24,000. That means 60. Okay, and total cost being 75000, 15,000. Yes. Okay, so total non-current asset. Next part, current asset. Okay, so are we given the inventory value? Let us see. Inventory, okay, closing inventory for 34,000. Closing inventory. $34,000. Trade and other receivable. Okay. 40670 as calculated earlier. 40670. Okay, and cash in hand 150. It is kept as cash float. Okay, that means it is always there. 34,000 40670 plus 150. It is 74820, and then the total asset being 134820. Okay, total. Okay, next part, equity. Opening balance. Okay, add, we have the profit for the year. And then we also have drawings. Okay, so opening equity, we have to look back. We have 50150, and then drawings, okay, being 25,000. Okay, let us write it down first. 50150, drawings being 25,000 negative. Okay, so profit is calculated in the previous part, 37769. 37769. So we have closing equity being 37769 minus 25,000, 62919. Okay, next part will be our non-current liability, because it is paid in 5 years time, 5-year bank loan. Okay, so 6% loan. Okay, and it is 50,000. And then we have current liability. Okay, we have two parts. Okay, trade and other payables already calculated. And then also bank overdraft. Okay, so trade and other payables 8551. And then our overdraft 13350. 13350 8551. Okay, perfect. Plus 13350 219101 plus 50,000 71. Okay, like this. Okay, moment of truth. Yes. Okay, it can be balanced. 134,820. Finish. Total equity and liabilities. Done. Great. So 5 marks, okay, easy marks for you. So identify whether each of the following will have effect on gross profit. What? The effect on gross profit of the omission of each item. Okay, so gross profit. Gross profit. Okay, that means everything in the trading account, okay, will be affected. Okay, others will not be affected. I mean, will not affect gross profit. So, goods taken for own use. So, if we omit goods taken from own use, okay, that means purchases will be overstated. Okay, purchases overstated. It means that cost of sales will be overstated. Cost of sales overstated. Okay, that means gross profit will be lower. Okay, purchases overstated. Cost of sales. Okay. Second one, cash taken for own use. Okay, there will be no effect. Okay, because it only affects cash and drawings. Inventory stolen. Okay, let's see. If we have inventory stolen, okay, that means our closing inventory would be understated. Closing inventory understated, it means that cost of sales, let me see, cost of sales would be overstated. Yes, if cost of sales is overstated, understated, inventory understated, cost of sales overstated. Yes, that means no, let me, oh no, like this. Okay, I should say it like this. Okay, let us take a look of these two possibilities. Okay, so we have revenue, cost of sales. Okay, so opening inventory, add purchases. Okay, less stolen goods, closing inventory. Okay, like this, and then gross profit. Okay, so if we have opening, okay, this is correct, this is omitted, okay, then it is like this. Oops. Okay, so if we omit the goods stolen, because goods stolen is a loss that will go into your expenses. Okay, if you omit this part, okay, this one in purple, okay, if you omit this, then that means you will have a negative effect omitted. Okay, then your gross profit, your cost of sales, would be, let me see, if you do not reduce the amount, okay, your, what happened to me? Your cost of sales would be, yes, overstated. Effect. Cost of sales overstated. Your gross profit would be understated. It should be like this. Yes, okay, my original thinking is correct. Okay, if it is overstated, yes. Yes. Okay, later I'll explain why I have this doubt. Okay, so let us continue. Carriage inwards, there will be no effect. Okay, because it goes into your expenses. Okay, next one, carriage in. Carriage in, your carriage in would be omitted, then purchases will be understated. Okay, purchases understated, that means cost of sales would be understated. Okay, then your net profit will be overstated. Okay, good. Yes, if inventory stolen, yes, I guess so. Okay, why? Okay, I have this doubt because I will also look at the answer key, and it says for inventory stolen, okay, we will have here. Okay, I don't know why. Okay, because if inventory stolen is omitted, then the gross profit will be understated. It is correct. I mean, my answer is correct. Okay, because you put what should be in your expenses to the cost of sales. Okay, overstated cost of sales. Okay, I don't know why. So I will keep my answer here. Okay, it should be like this. okay, according to our analysis. Okay, so this is question 4. Let us move to question 5, statement of cash flows. Okay. Okay, so the following information is given. Okay, this incomplete statement of cash flows. Okay, we have information and then we have to calculate the value of equipment acquired, profit or loss on disposal, and also dividend paid. Okay, and then we have to fill in. Okay, so you can see we have depreciation charge, we have loss on disposal given to us, it is a loss already. Acquisition of equipment, okay, and the proceeds, okay, and of course the 2 totals, 3 totals, and then dividend paid. Okay, so let us start. Okay, not much information given to us. On the 1st of April, okay, that is the year start, year 2019, 1st of April, equipment had a carrying value of 1775000, opening balance of non-current asset. Okay, and on the 1st of May, year 2009, okay, that is 1 month afterwards, equipment costing 500,000 with accumulated depreciation 325 was sold for 140,000. Okay, so we can calculate disposal gain loss here already. Do we need? No, we don't need any working. So I will work out here. Okay, just like the previous questions, we have the proceeds here, okay, less the cost and the accumulated depreciation, okay, and then we have the disposal. Here we are told that it is a loss, so I write it here. Okay, here. Okay, the proceeds being 140,000, the cost 500,000 with 32500. Okay, that means the carrying value of the disposed asset being 175,000. Okay, 140 minus 175. That means we have 35,000 disposal loss. Okay, so I can write it here first. 35000. Okay, disposal loss. Okay, so let's continue. On the 31st March year 2020, that is the last day of the year, depreciation charge on equipment 575. Equipment had a carrying value of 2050. Okay, and then that's all for for non-current asset. Okay, so closing balance given to us 2050,000. Okay, opening balance at purchases minus disposal minus disposal minus depreciation is equal to closing balance. Okay, we have the disposed asset carrying value 175,000, depreciation given to us being 325, being how much? 575,000. Okay, that is a simple equation. We can solve it. 1775 minus 175 minus 575 2050. Okay, being purchases 1025000. This is what we need to find. Okay, and for this one, we need to give the calculation, okay, for 3 marks. Okay, so I will just use this one, 2050,000 minus 1775, is it? Let me check, yes. And then 175575. Okay, it is always good to use an equations to solve this type of requirement. Okay, because an equation gives you a straightforward logic, okay, in working out any component that you need. Okay, if you see these type of workings, okay, you might easily get confused. Okay, so I always use equation for logic first and then copy back all the things that we need, okay, as an answer. Okay, so next part is the dividend paid. Okay, but before we go on to dividend paid, I would like to point out all the items that we need to put into the statement of cash flows regarding non-current asset. We have 4 items for non-current asset. Okay, first one, okay, we always have, not always, but most of the time we have an investing activities acquisition payments for the acquisition of new non-current asset, okay, negative. Okay, and we almost, not almost, but we always have depreciation. Okay, operating activities positive because it is a non-cash expense which is to be added back to the profit to get reconcile it to cash flows. Okay, next part, if we have the disposal of asset, we will have 2 extra items. Okay, the proceeds investing activities positive because it is a receipt of cash. Okay, and also operating activities for disposal gain or loss. If it is a loss, then we add back because it is a non-cash expense. Okay, so 4 items, I marked it out first. Okay, and then next part we will have the dividend. So 200 bonus shares, £1 each, were issued in the ratio of 1 share for every 6 shares held. Okay, let me see. Oh, this is very interesting because for a bonus issue, we don't have any cash effect. Okay, but then we are given that we have a bonus issue of 200,000 shares. Okay, and this is in the ratio of 1 share for every 6 shares held. Okay, that means we have to use it to find how many shares does this company originally have. Okay, so if, okay, original number of shares, okay, we do not know, this is an unknown for you. Okay, and then multiply by 1/6 because 6 shares for 1 bonus share. Okay, and then we have 200, okay, bonus shares. Okay, again, it is a simple equation. That means we use 200,000 times 6, 120. Okay, like this. Originally we have that. Okay, but then we don't need this. This is not, there is no cash effect for bonus issue. Okay, why do we need this? Because we have to calculate the amount of dividend. Okay, dividend of 0.05 per share was paid on all shares issued before the bonus issue. Okay, that means the original number of shares. Okay, so 0.05, so we can, oh, what happened? Okay, we can do it directly here. Dividend paid. Okay, we have just now 20,000 multiplied by 6. This is the original number of shares, and for each share 0.05. Okay, so it is $60,000. Okay, this would go into your financing activity negative because you pay dividend. Okay, so we have found all the necessary information. 60,000 here first. Okay, 150, so that is 4, 5, 8, 60,000. No, 150 minus 60. We have 90,000 here. Okay, so acquisition of equipment 1025, if I remember correctly. Proceeds, I forget. How can I remember? Okay, let me move it down. Okay, 1025, correct. Okay, proceeds 140. Okay, this one is negative. Okay, and loss on disposal 35,000 added. Okay, and then depreciation 575,000 positive. Okay, so we can calculate all the totals. 25 plus 140, 885. Okay, 373. 373. Okay, I really have to be careful. I am always too careless. 610. Okay, so these three added together. Okay, we have 185 negative plus 120. So closing being 65 negative. Finished. Okay, last part. Discuss whether the company should issue shares or debentures to finance the purchase of a new factory. Okay, so new factory here. So this is capital structure. Okay, we have discussed this earlier. Okay, shares or debentures. Okay, capital or liability. Okay, so I would discuss both points and then draw a conclusion. Okay, usually when I write on this, okay, it would be more than it requires. Okay, so issue shares or issue debentures. Okay, so for issue shares, it is good in one thing. Okay, do not increase the interest burden on interest payment, and also when the debentures falls due, okay, you also have to return the amount. okay, and you have to repay it first. Okay, if you fail to do that, fail to pay interest, fail to repay the debentures upon maturity, okay, you can go bankrupt. Okay, and that's the problem with debentures. Also, they do not have a maturity date. Okay, and when you do this, okay, it will also not affect the profitability. The profitability ratios and also the gearing ratios. Okay, but then for issuing debentures, it also have its own benefits. Okay, first of all, if I am a shareholder and I want, I know the company want finance. Okay, it would be nice if it is medium term. Okay, because if I issue shares, if the company issues shares, that means the shareholding is diluted. Okay, so for supporting debentures, shareholding, okay, or ownership will not be diluted. Okay, it would also be good if debenture interest is lower than current return on dividend. Okay, it is because if you are receiving a dividend rate of maybe 12% and then you can borrow for 8%, it is always good because the cost of capital will be lower. Okay, and then we have to see, for the debenture, if later we can replay, can be redeemed. Sorry. Okay, that means you are not borrowing the money for life. Okay, you need the cash immediately for the purchase of the factory, and then because of this you can gain more profit. Okay, and with the profit you can use to repay the liability. Okay, then all the profit afterwards go back to the shareholders. Okay, so it depends on whether you are a shareholder or not, okay, and whether the company is currently making good profit or not, whether the interest, the market interest rate is good or not. Okay, it depends on so many things. Okay, and to make a conclusion, you can conclude on either side. Okay, it doesn't matter. Just give one most important, most significant reason to support it. Okay, then you'll get the 5 points. Okay, so my voice is gone. Okay, we finished this set of paper. Okay, and we used 2 hours to finish it. That means this one is a little bit easier. Okay, and hopefully very soon we will deal with another set of paper. Let me see whether it would be tomorrow or another day soon. Okay, so see you. Bye.